guys, welcome back to another week of Mortgage Matters in Minutes. Week and episode 170th. So, we're talking today about temporary buydowns, which is generally a word most people don't understand or know what it means. But is a temporary buydown, what is it, and is it worth it? Let's talk about that. Temporary buydowns first are a way to lower your mortgage payment. So why wouldn't everybody want to do that? Because everybody wants to save money with the lowest payment, basically lowest interest rate that's out there. So we're going to explain today what a temporary buydown is. And before we get to that, again, please comment below if you have any questions or concerns or topic ideas. We'd love to answer anything that's out there for our regular clients and or followers to see if there's a topic that, hey, I came up with this the other day and never heard of it. What can I answer about this or that? Also, hit the subscribe button. We would love to have you follow us each and every week or just as time permits into your schedule. So what is a temporary buydown? A temporary buydown is putting up money to take a interest rate that's cheaper over the first few years, whether that's the first year, second year, third year. You're putting the money up front, as I stated, to take a cheaper interest rate. So a buydown is not free, a temporary one or a permanent one, but today we're specifically talking about temporary buydowns. You might see the number where it says 1-0 or 2-1 or 3-2-1. What that means, for example, is let's go with the 2-1, which is most common temporary buydown. Let's say today's interest rate is at 7%. So the first two means you get a 2% lower interest rate the very first year. In the second year, you get a 1% lower interest rate. In the third year, you get the full indexed rate that was the market locked you in at 7% for the next 30 years. So what's nice about a temporary buydown is in the short run, you get a much cheaper payment and it gradually goes up over the first couple years. So let's talk about who pays for it. You as the buyer does not pay for that buydown. It's an incentive that either the seller, the lender, or the builder is going to put up and pay for you. It is not free. Basically, that savings that you obtain gets paid in advance to lower that interest rate. So why would someone do that? Well, there's many reasons why someone may want to look at taking a cheaper interest rate. Maybe they're starting a new career. Maybe they're just out of college. And like most of us, our income was quite a bit lower the first couple years. As time goes on, generally speaking, our income starts to increase. So we can gradually gain up to that full interest rate and full mortgage payment where we get a little bit of a price paying at the beginning. Or there might be a reason that the house that you're looking to purchase is just not selling and the seller is going to put up the money and give you an incentive. You might as well take that incentive versus buying a different property that does not have that incentive. So let's kind of look at how the savings happens. If we're, as an example, borrowing, say, $400,000 at an interest rate of 7%, your first year interest rate would be at 5%. So you would save about $430 a month in savings. The next year, your interest rate would be 6%, 1% less than 7%, and you would save about $230 a month in savings. At year 3, obviously, there's not going to be any true savings at that 7%. So what happens is we add up 12 payments of $430 savings, 12 payments of $230 savings, and this is what the builder seller has to put up front as an expense of saving that money. So is that always a good thing? Yes, no, maybe. Possibly it is a great thing for you, obviously, having that lower payment. It's better cash flow for you. You can take, obviously, monies as opposed to applying them towards the mortgage and using them there for the home, for furniture, utilities, appliances, whatever else that the house might need as well, too. The cons is it really doesn't change your long-term costs because someone is already paying for it. So instead of paying down that buy down interest rate, what if you took that money, paid down closing costs, paid down taxes and insurance instead, and you kept your money and invested it? So there's never a perfect scenario that's right or that's wrong. Every scenario is different depending on your needs of what you may need for a loan. This also could create payment shock for people, assuming that they're going to continue to get this lower payment. And their goal is hoping that in 2 or 3 years, they would be able to refinance out of that loan at a cheaper interest rate. If that cheaper interest rate doesn't come along, you are stuck there at that 7% interest rate, for example, over the next 30 years. So these have a big need in the market right now as people see interest rates being higher, and we're anticipating interest rates coming down here in the future. So it's a time that people are bringing this conversation up, and we're explaining this same scenario to them so they understand their choices. It's good for buyers, it's good for sellers, and it's good for the market because there might be a property out there that's taking more time to sell. So realtors might entertain the idea of, let's give out some incentives, and this temporary buy down happens to be one incentive. That's a possibility to advertise, to put out there for some buyer to gain a little bit of savings over the first couple of years of a loan. We're always here to answer questions. We'd love to chat with you. Please like and subscribe and comment below, and we'll see you here next time at Your Mortgage Matters in Minutes. Have a great rest of your week. Mortgage Specialists. Driven, trusted, reliable.